Welcome to TMS Insights June 2020. Ben Clark and Jeremy Hook bringing you an update, almost a metre and a half apart, but it's been a really hectic time as we come to the end of the financial year, Ben. The markets continue the recovery from April and May, and really what we're looking at here is the macro settings. Can the market continue? And why has it got here? And I think it's really important to understand the massive effects that are working on global financial markets from central banks and governments to keep asset prices moving and to keep the economies from really sharp dips.
Yeah, I think there's a lot of stuff going on in the background which probably clients aren't as aware of, and there's been a lot of talk about a disconnection between share price and the reality on the ground, and a lot of debate, particularly amongst a lot of fund managers who have been, I think, caught out by this very rapid repricing of assets right around the world. And one of the big things driving this is the intervention by central banks. And if you look back to I think in April, the US Fed injected $1 trillion of liquidity into bond markets, which was actually more than they injected throughout the entire GFC, and they did it in 1 month through quantitative easing sort of programs. So the flood of liquidity that came in, there's no doubt has helped support prices.
It's important to say, because we're doing government paper, which is one thing, and it's a massive scale, but buying back government bonds, etc., is normal activity for a central bank. And I know you're about to get onto this, but the buying of corporate bonds, which was announced just on 2 weeks ago, was a new paradigm altogether.
Absolutely, and that was, we had a couple of nasty days going into the weekend a couple of weeks ago, and then we had this rapid recovery, and that was really to do with the Fed announcing that they were going to move into the corporate bond market. It's moving into more experimental territory, I would say, but extraordinary times, and there's arguments for and against what the Fed are doing. I think the biggest thing I've learned out of all of this is don't worry about what you think about they should be doing. All you should worry about is what they are doing and what you think they're going to do.
What you know rather than what you think and guess. Because the one thing is you don't want to be in this predicament to have to deal with it. But when you are, you need to deal with it.
Yep.
And that's exactly what central banks and governments are doing. So you can hardly accuse them of underaction at a time of real need, because that's what they need to do. We have to sort it out later, and we have to do that, but it's important they do that. So yes, we've seen that, obviously the monetary stimulus, but this is another level, just stopping bonds becoming sub-investment grade, keeping a nice big and healthy corporate bond market, and that allows businesses to borrow and do their thing and invest in business.
It also gives the big global pension funds, etc., liquidity. And, if they're selling to the Fed their large holdings in corporate bonds at what they believe is fair value, they'll get cash back. They're not then going to spend it on other corporate bonds at the same price. They will look in other asset classes to invest. And that's what's fueling equity markets and other markets as well, other asset markets. So, and, the RBA is doing something similar. That the Fed, Jerome Powell said, we are watching closely what Philip Lowe is doing, because he believes that the RBA is basically engineering interest rates in this country at the moment.
Yield curve management, really, which is...
It's a nice way of saying it.
Nice way of saying it. But it is. They're highly active at the moment, but we're at a time of amazing intervention, and watching governments and watching the big central banks and their actions. You must do that. You must understand their motives and how it impacts. And as you said, Ben, it's a magnetic impact on asset prices. It helps them up. So while the professional investors, some of the best high-profile fund managers in Australia and globally, are shaking their heads at this rallying equity market, there's a simple underlying fact that the monetary liquidity enables this, and that will never go away.
And the old saying is truer than ever, don't fight the Fed. And what it is creating, I think, is a number of these managers who are sitting either on very large cash weightings, believing there's another wave of very nasty news, and surely equity prices have got to reflect that at some stage. They're looking at this intervention saying, maybe equity prices throughout this crisis never will reflect where share prices should be, but we are going to see a pickup, of course. And so the dips are getting bought more aggressively because they're sort of saying we need to start getting money into this market.
Yeah, so it's not that we're sitting here to say that we can see the market going ridiculously higher in the near term. We've got our concerns as well, and we keep our clients making sure that they've got sufficient cash to ride through all sorts of issues. But to explain the movements we've had, there is some logic. So the idea that these professorial type of people are telling everybody that there's no logic in the market rally, that's actually not true.
No, and it misses what has been probably one of the biggest features since the GFC is intervention into asset prices, and it's something I think it is going to continue, whatever you think about it. So that's what you need to focus on.
So getting towards the investment side of things a little bit, Ben, one of the things we've noticed from this crisis, unlike maybe some others, but there are changes that are going on that we wonder, are these long-term changes or not? And we'll talk about some of them in a sec, but it would be fair to say that things that were happening beforehand, the rise in digital activity and the rise in AI, etc., has sped up through this process.
Yes.
So looking at a couple of areas, let's talk technology. I mean, providing great opportunities. So, and to a stock level, some upgrades from companies exposed to that.
Yeah, I mean, we've seen locally, we've seen some pretty good results. We saw Xero have a very good result in March, although they did warn about a couple of features of their business that could be affected by Corona. Appen has been, I think, hit an all-time high a couple of days ago and has been on a tear. Different technology businesses are all, and I think this is true of the broader market, there's opportunity out of this and there's also some impacts to the business. And it's different for every separate business. And the recovery of the impacts will look different for every different business. And, we'll learn more about this as the reporting season unfolds in August. But there's no doubt that both here and particularly in America, I would say the big tech stocks there, this has sped up themes that were going to play out anyway.
Right.
But it's probably leapfrogged 3 years as a result.
So Amazon's a great example, all-time highs with their business. They've been putting people on. They could not have been busier.
Yep.
And it's just moved them forward. They were growing rapidly beforehand. So
yes. Yep.
It's happened. Okay, so what about the credit card environment? So, we've got a number of players here, both listed and here and overseas, but obviously we know the contactless payment levels have gone up and people are preferring to avoid cash, etc.
Yeah.
We're a high user of these products already in Australia, but thinking globally, there's a lot of penetration for credit cards and payment systems globally. What does that space look like at the moment?
Well, I think there's these, and we spoke about Visa and MasterCard as potential buyers, I think, a couple of months ago. Those stocks are almost back to all-time highs now. And again, it sort of goes back to what I was just saying about tech. In the short term, there is less transactional activity occurring across the globe because the lockdowns are slowly being eased, quicker in some parts than others. But of course, we all know there's less people in pubs and restaurants and all that sort of thing. However, the acceleration of the trend that was going to occur anyway has just taken a big jump. And people who may have been reluctant to use tap and go in the past were sort of forced to use it in the last few months. And once you start using it, you don't stop. You don't go back to cash. So, and the governments would be sort of largely cheering this on because they want the world to go cashless. They can see what's happening.
It's a black economy, doesn't it? Yeah. Tyro and the Australian market are a relatively new listing here. Very well exposed to this.
Yeah, I think it's one of the only ways you can really play it on the Aussie exchange. And Tyro's one we've kept a close eye on, mainly because they've given us great transparency into what's actually happening in real time in the economy. Every week that they've been reporting what the transactional volumes going through their merchants has looked like. They're number 5th after the 4 banks. And this is a business that is attempting to eat into some very profitable parts of the bank's business through a really good tech platform, hardware offering that merchants we've spoken to sort of rave about, and then rolling them into lending platforms and to transactional accounts and looking after a lot of the things that the banks typically would do. this is one of the threats that the banks really will face over the next decade is companies like this. It's a $2 billion company now doing it better, faster, cheaper than the banks typically have.
It hasn't all been good news. Obviously, property and the commercial property side of things, obviously the tourism sector doing it tough. So property, Ben, commercial property particularly, looks like it might have some real strains ahead of it.
Yeah, there's definitely, and it goes back to the market. There's some companies that have just suffered a real windfall out of this, and there's a lot that have very unfairly, you would say, have been completely sideswiped by it. And, I was in the city for the first time last week since it started, and I was amazed at how empty the city still is. Looking at office blocks, and every single level is completely empty, and you wonder what those buildings are now worth in this environment, and what the leasing looks like. And it's the same in shopping malls and a lot of different commercial property classes. So
just quickly as we wind up, end of financial year, only a few days away, we see a lot of activity around that end of tax year selling and things of that kind, but also fresh new year in July 1. So portfolios get repositioned, expect some volatility in turnover.
Yep, definitely. And I think we're going, the heads up I would give clients is we are going into what is going to be one of the most interesting reporting seasons we've ever seen, because most companies withdrew guidance in March. Most analysts for the first time in a long time are not being guided by business as to where their numbers will probably lie. So there's big dispersions in where analysts are expecting profits to come in at. And then, we'll be listening to the calls, and we know it's going to be a pretty brutal reporting season, but what we'll be trying to get a feel for is where do the earnings go from here? What's the recovery look like? What's the time frame? What's the quantum it will take? And I think that's the biggest insight. So I think you're going to see potentially some knee-jerk sell-offs, but then fundies and stuff looking through and sort of thinking, okay, well, what does 2022 look like, and 2021, and that will be the critical.
It'll all be about guidance and how the outlook is. We're going to bring you a big review of what we think the reporting season will look like in that next TMS Insights for July. So we'll wrap up now and look forward to bringing you the July update to advise on what we see that important August reporting season looking like.